Every day, thousands of people open a trading app, press buy, press sell, and still they don't really know what they are doing. Some win by luck, many lose by emotion. The truth is simple. The stock market is not complicated, but confusion makes it look complicated. Beginners think they must learn everything, charts, indicators, daily predictions. But the real game is much simpler. It starts with understanding where your money goes, then learning how patience multiplies it. Not overnight, not next week, but slowly, quietly. If you follow the right roadmap, even 500 rupees can become the start of wealth. And today, you will see that roadmap. No jargon, no confusion, just the basics that actually work. Because in the stock market, clarity is more valuable than prediction. And once confusion disappears, discipline begins. Disclaimer. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Content, main roadmap. Step 1. Understand what the stock market really is. A stock is ownership. When you buy a share, you own a tiny piece of that company. For example, if you buy $1,000 worth of shares of a large Indian company, you become a micro-owner of that business. If the business grows, your share value grows. If the business struggles, your value may fall. That's the first clarity. You are not gambling. You are investing in businesses.
Step 2. Start small. Most beginners think they need 50,000 rupees or 1 lakh rupees. You don't. You can begin with 500 rupees or 1,000 rupees per month. Consistency matters more than size. This is where SIP becomes powerful. SIP means Systematic Investment Plan. Instead of investing a large amount once, you invest a fixed amount every month. Example, 2,000 rupees per month for 10 years. If the market averages around 12% annually, that disciplined habit can cross 4.5 lakh rupees. Not magic, just time and consistency. Step 3. Use asset allocation. Never put all money in one place. This is the mistake many beginners make. A balanced beginner allocation may look like this: 60% in equity mutual funds or stocks, 20% in debt funds or fixed income, 10% in gold or gold ETF, 10% as emergency cash. Why this structure matters? Because markets move in cycles. Equity rises, equity falls. Debt gives stability, gold protects during uncertainty. Allocation protects the investor from their own emotions. Step 4. Understand risk cycles. Markets never move in a straight line. There are bull markets, there are bear markets. Bull markets create excitement, bear markets create fear. Both are temporary. Example, if you invested 1 lakh rupees before a market correction, your portfolio may drop to 80,000 rupees. Beginners panic. Experienced investors stay calm because they understand cycles are normal. The market rewards patience, not panic. Step 5. Rebalancing keeps your strategy stable. Imagine your portfolio after a strong bull run. Your equity portion may grow from 60% to 75%. Now risk has increased. Rebalancing means adjusting back. You move some gains from equity into debt or other assets. This protects profits and resets your risk level. Serious investors do this once a year, not every week. Step 6. Understand taxes early. In India, capital gains taxation matters. Short-term gains from stocks held under 1 year are taxed higher. Long-term gains after 1 year have lower tax treatment. So patience again becomes valuable. Frequent buying and selling creates tax leakage. Long-term investing keeps more money with you.
Step 7. Avoid common beginner mistakes. Mistake 1. Following random tips. Mistake 2. Checking portfolio every hour. Mistake 3. investing based on fear of missing out. Mistake 4, selling during market panic. These mistakes destroy discipline, and discipline is the real advantage in investing. Step 8. Scale slowly. Once your monthly investing habit is stable, increase contributions from 2,000 rupees to 5,000 rupees, from 5,000 rupees to 10,000 rupees. Income grows, savings grow, investments grow. Wealth is not built by one big investment. It grows through years of consistency. Step 9. Adopt the long-term mindset. The stock market rewards time, not speed. Many successful investors hold assets for 10, 15, even 20 years because compounding needs patience. A small investment, given enough time, becomes powerful. Step 10. Master emotion. Greed pushes people to buy at the top. Fear pushes people to sell at the bottom. The disciplined investor does neither. They follow their system, month after month, year after year, quietly building wealth. At the beginning, the stock market feels confusing, too many opinions, too many predictions. But once you understand the basics, the noise disappears. You stop chasing excitement, you start building systems. And slowly, your future self begins to thank you for the patience, for the discipline, for the clarity. Because wealth rarely comes from one decision, it comes from thousands of calm ones. And the investor you are becoming today is the reason your future becomes secure.